All right, so welcome back, everyone. This brings us to our last session of the day. So I can see that the participant number has dropped in Zoom webinar down to 130. So I think that just leaves all of us diehard accountants here today that want to hear about lease accounting, analyzing, and journalizing. So at this time, I'm going to turn things over to John Holden. And John Holden is going to introduce our next speaker.
Good afternoon, everyone. Our speaker this afternoon is Sam Latimer. Sam is a certified public accountant with Rushton & Company in Gainesville and Carrollton. The firm specializes in auditing and consulting with local governments, authorities, and nonprofits. He's an audit manager in the firm's governmental and nonprofit section. Sam has over 13 years of experience working with local governments of all sizes, assisting them with financial statement audits, internal controls, compliance, single audits, bond issues, chart of accounts, and other governmental areas. He's a frequent presenter at the annual GGFOA conference and has assisted many governments throughout Georgia. Sam is a 2006 graduate of the University of North Florida with a BBA in accounting. He's a member of the Georgia Society of CPAs, the GFOA, GGFOA, the Association of Certified Fraud Examiners, the AICPA, including their Governmental and Audit Quality Center. With that, I'll turn it over to Sam.
John, can you share my screen?
Sam, are you there?
Yes.
Do you have PowerPoint slides you're going to share? Oh, I got it.
Yes. My video is not going though.
If you look for the little button next to the mic that says start video, can you click that? There you are. We see you now.
Oh, there we are. Hello, good afternoon, everybody. I'm here to talk about lease accounting, like John said. I wish we were all in person together, and but it's I wish I could see everybody's faces. But either way, it's good to be here and talk about lease accounting. I was just thinking, I think this is the third or fourth time that I've presented this lease accounting, and it's been more of a general view. And so today we're going to go over a lot more analyzing and journalizing, just like the name says. So we're going to dive into hopefully some of the journal entries and some of the more technical parts of the GASB 87. So feel free to ask any questions. John Holden's going to let me know if there's any questions, and we'll stop and try to answer those. So feel free to raise your hand, and we'll get started here. So we're here to talk about GASB 87. So hopefully at the end of this session, you'll be able to implement GASB 87. You'll be able to hopefully analyze a lease and determine how that should be treated under the GASB 87 models. This is a big standard. This is going to affect almost every government. It's hard for me to think about a government that doesn't have a lease and won't have to implement this model. But I think once you dive into the new 87 model, it's a lot different than what we've been used to. But it makes a lot of sense once you dive in and kind of see what they're thinking. It kind of makes a lot more sense. So hopefully by the end of the session, you'll also be able to create an inventory of your leases to analyze so that you can implement GASB 87. Implementation has been delayed again, and I'll show you a slide on that in just a minute, but nevertheless, it's coming. I feel like we've been talking about this standard for a long time, but it's delayed again, so it'll be here before we know it. The bad thing about delays is that you can put it on the back burner and kind of forget about implementing. Hopefully that's not the case. I hope all of you have gone ahead and started implementing 87 and started gathering all your lease information to get 87 implemented. So like we said, we're talking about 87, GASB standard 87 leases. Very appropriate name for a standard that's about leases. Like I mentioned just a second ago, GASB 95 postponed GASB 87 implementation for 18 months. It implemented, it postponed a lot of standards that GASB was due to implement. Most of those were delayed about 12 months, but I think that GASB had a little mercy on us because they knew that GASB 84 would end up in the same year. And so implementing GASB 84 and 87 and 84 in the same year would be quite burdensome. So I think GASB gave us a break there. Thank goodness they did. So it's effective now for periods beginning after June 15th, 2021. Two fiscal periods that are probably the most used is December 31st and June 30th. So it'll be for years June 30, 2022 and December 31st, 2022. So those are the years to look out for. Nevertheless, though, you still need to go ahead and start preparing for this. There's a little more work to get ready for this standard than there usually is for other standards. So just be on the lookout, and I will go ahead and start gathering some lease information now if you could. And we'll talk about that as we go. So how did we get here? FASB and the IASB conducted a joint project to implement, to update their lease standards. GASB said we don't want to be left out of the party. So they wanted to implement their lease standard as well. You can see that as we go through, the entire lease model, it has changed. We're no longer doing, or we no longer have to consider operating and capital lease classifications. So GASB 87 really changes the entire model of how we think about leases. It's really no longer operating versus capital lease. It's more, is it a lease? Is really the question we ask now. So 87 amended GASB 62. We're now required to recognize a lease asset and a lease liability. A lot of these that will be considered in this standard will be the operating lease. So items that were formerly classified as operating leases will now be capitalized and will have a right to use intangible asset. And that's based on the founding principle that all leases are a financing. And like I mentioned, it eliminates the operating and capital lease classifications. And so the goal of the standard was to enhance the relevancy and consistency of a government's leasing activity. So a lessee is required to recognize a lease liability and tangible right to use asset. A lessor is required to recognize a lease receivable and a deferred inflow of resources. And then they will recognize revenue over the life of the lease, of course. And so looking at this side, you can see this is the previous guidance. And so governments, while we really followed the FASB standard and we were very similar to the way we accounted for leases, just like FASB. If you look at all this guidance here, we had there's 1, 2, 3, 4 different items that really kind of brought all our lease guidance together. And so really implementing this standard has really brought it all together into one cohesive single model. And so it's actually really kind of simplified it if you think about the guidance that leases previously, the previous guidance. So it's really kind of simplified that into one. And I think once you dive into it, you actually kind of get to like the way it is now versus the older way or the previous way. So like I mentioned before, current guidance, there's a lot of leases that are reported as operating leases. And of course, an operating lease that it doesn't show up on a balance sheet. So there's no liabilities recorded. So that can tend to be misleading, really kind of depends. We only disclose those. There were no assets reported through the government receives a legal right to use the underlying asset. And then like I mentioned before, you have the 2 primary classifications in the old guidance, which was capital versus operating, which like I mentioned now changes to, is it a lease versus what it used to be, is it a capital lease versus a operating lease. You'll see that most of the leases that are affected by GASB 87 are operating leases that are now going to be treated as a lease under GASB 87. And then some of the items that we treated as capital leases will now be excluded because those are considered financings. But I'm getting a little bit ahead of myself. I'll wait till we get to those slides. So classification, this is, from the lessee perspective. The current guidance, you remember we all during school or at some point have looked at or had to review or memorize these 4 items, these 4 criteria for what is it a capital lease. So anytime we had a new lease, we would take a look at, does it have a transfer of ownership? Does it have a bargain or purchase option? Is the lease term 75% of the economic life of the asset? And really, if you break all of these criteria down, it really comes down to, we were really deciding whether or not those leases were a finance purchase. So at the end of the day, substance over form, even though it's called a lease and we say that we're leasing, aka renting the asset, at the end of the day, a capital lease really represented a purchase, a finance purchase. And so you'll see a lot of those leases that we called a capital lease are going to be excluded under GASB 87, and they're going to turn into a finance purchase, and they should be treated like a finance purchase for reporting. And then, of course, if it was not a capital lease, then it was considered an operating lease. And so under the previous guidance, the capital leases where you would debit a capital asset and you would credit a long-term debt liability. And then that would be at the present value of the future lease payments. You'd have a debt schedule for that. And then you would disclose the future minimum lease payments under the lease. And then operating leases under the guidance, the previous guidance, you would expense payments as they were made. They would never make it to the balance sheet, but they would be expensed in an expense, and then you would disclose the future minimum lease payments. And so that brings us to our first polling question.
All right, I'm going to go ahead and launch that poll. So GASB 87 leases amended. Which GASB statement? Got 4 choices there. GASB statement 34, GASB statement 72, GASB statement 62, or GASB statement 1. So again, no penalty if you answer incorrectly. I'm not looking at who says what, but we do hope you'll participate and pick a choice here. I'm going to give everybody about 5 more seconds to make a selection, and then we'll close it out and see how people did. All right, I think that the selecting process has slowed down here, and it looks like more than half selected GASB statement 62. How did they do?
They did very well. That's the answer. The statement, it was GASB statement 62. So good job, everyone. That was the codification standard, and that's the official statement. Like I said, there were multiple guidances that kind of came together, and GASB 62 was the one that really brought those together. And then GASB 87 will supersede that, and that's what we're going to dive into now. So leases, the new standard. So the definition of a lease is a contract that conveys control of the right to use another entity's non-financial asset for a period of time in an exchange or non-exchange like transaction. So it conveys control of for the right to use the asset. So you're not actually purchasing an asset. You are getting the right to use that asset, and you need to have full control of that asset. And it needs to be an exchange or an exchange-like transaction. You'll see later on when we talk about it, but items that are really below fair market value, that really doesn't apply here. We need to be talking about things that are material. So So it's a contract that any contract that meets this definition should be accounted for in the lease guidance. And then there are some items that are specifically excluded, and we'll go over all of those. And so when we say non-financial asset, like what exactly do we mean? And we basically it basically means it's not an investment under GASB 72. We implemented GASB 72. I feel like it's been such a long time, but I think it was only about 4 years ago. And that really clarified what was an investment, and it helped determine how to account for certain investments and do leveling on how you came up with the price of the investment. So some examples of a financial asset would be cash, evidence of ownership and an interest of an entity, or some contract that conveys the right to receive cash from another entity. All of these are excluded. So to become under the guidance of GASB 87, we really it needs to be a non-financial asset. Some examples of those are land, building, vehicles, equipment. I'm sure many of you have a lease right now that uses one of those types of assets. And so let's talk a little bit more about conveying control. And so conveying control is the right to obtain the service capacity for the use of that asset. You need to really control the nature and the manner and use of the underlying asset. So that's the right to use the asset. You're not buying the asset itself, just the right to use it. And so not all the burdens of benefits of ownership are transferred to the owner. Because if it was transferred, then you'd have a finance purchase, and you'd end up you'd have to account for that as a finance purchase and not under GASB 87. So, and control is not limited to contracts that convey substantially all the present value of the asset. So, for example, if you had an asset that has a 50-year life and you're leasing it for 10 years, that would fall under GASB 87. You need to account for that under GASB 87. Let's not forget, substance over form. Anytime that we're doing any accounting, really substance over form would apply. But definitely under the lease guidance, there are contracts that may not be called a lease per se. I've seen leases called multiple different things. They can be called lease terms. The notes payable. They can all kinds of ways that leases can be defined. But at the end of the day, we need to look at the items in the contract and determine whether that's a lease or not. So they must meet the definition of a lease, and then vice versa. Also, a contract can contain a fiscal funding clause and still qualify for exclusion. So even if it's not reasonably certain to be exercised, and we'll dive into that on the next slide. So one item that would exclude under GASB 87 would be transferring ownership. This is what we call the ownership exception. So any contract that you actually buy the asset, then it would be excluded under GASB 87. So if a contract transfers ownership of the underlying asset to the lessee at the end of the contract, it would be excluded. And it does not contain termination options other than fiscal funding or cancellation clauses. So these types of contracts, they're not a lease. These are really finance purchases, and they should be reported as a finance purchase. And I've got a couple examples of those. If you look here, I'm sure you've all read the details of a lot of your leases. Contracts that transfer ownership. Here's an example. This is just to show you that it's sometimes you really got to get down into the small details. But I've put it up there in bold. At the end of such term, lessee shall acquire legal title to the equipment and terminate this lease. So that's an example of an item that would be considered a finance purchase and therefore not a lease. So it would not be under GASB 87. And then I've got another example there. Upon expiration of the lease term, payment in full of all rental payments then due and all other amounts then owing under the lease for the payment of $1 to the lessor. So that would also qualify as a purchase. That's such a low dollar value you've essentially bought it. Again, substance over form, that would really qualify as a finance purchase. So I've got an example here. A vendor installs equipment in a government's building to increase energy efficiency. The government will own the equipment at the end of the agreement, and the contract does not contain a termination option. For financial reporting purposes, should this transaction be reported as a lease or a finance purchase? If you said finance purchase, you are correct. If the title of the equipment transfers to the lessee at the end of the contract, the transaction is not accounted for as a lease for financial reporting. Rather, it's a finance purchase. And you can find that at paragraph 19 of GASB 87. And so we talked to, I briefly mentioned earlier, there's some exceptions. So if it's one of the contracts and it has all the terms of the contracts that we described, you still need to go through these exceptions and determine whether or not it would apply or not. So there are exceptions. So short-term leases are an exception. A short-term lease is anything that is 12 months or less, and we'll go over all the details of short-term leases on the next slide. But intangible assets would be one that's not included. That's an exception to GASB 87, but that does not include the right to use intangible asset. Contracts that transfer ownership, I've talked about that. Biological assets are excluded. Leases of assets that are investments, so anything under GASB 72. Service concession arrangements, certain regulated leases, and then any supply contracts or leases of inventory would be specific exceptions under the guidance. So a little more detail on the short-term lease exception. The maximum term under the contract is 12 months. So that would include options to extend. So from the beginning of the lease, including any options to extend regardless of the probability of being exercised. Lessees should recognize expense or expenditure based on the terms of the contract. So you do not recognize asset or liability associated with the right to use the underlying asset for a short-term lease. Lessors recognize lease payments as revenue based on the payment provisions of the contract. And so you would not recognize receivables or deferred inflows associated with a lease that is 12 months or less. And I've got an example here. A government enters into a 12-month non-cancelable lease in which the lessee has options to renew for 12 months at a time, up to 49 times. Is this agreement a short-term lease under GASB 87? And of course, the answer is no, it's not considered a lease because the maximum, I'm sorry, it's not considered a short-term lease because the maximum possible term of a short-term lease is required to be 12 months or less, including any options to extend. The presence of the lessee renewal options, regardless of the probability of them being exercised, means this lease does not meet the definition of a short-term lease. So we've got our next polling question.
All right, I'm going to go ahead and launch that polling option. If you're having difficulty seeing the polls, now would be a time, I think, to try and change your view and exit that full screen mode if you have not tried that. But if you don't see this polling question, just pop your answer in the chat and we'll look there to see if people are responding there. All right, so which arrangement would be within the scope of GASB 87? Got several options there: renting office space, leasing computer software, power supply contract, or service concession arrangement. We're almost halfway there. I'm going to give you about 10 more seconds to make a selection and then I'll share the results. So remember, no penalties for incorrect answers, but if you want to give it a shot, you can do it. Make a selection now. Again, if you're having trouble seeing that poll box, just pop your answer in the chat box and we'll be able to see your responses there as well. All right, Responses have slowed down. I'm going to go ahead and close our poll. And here, if we look at the results, nearly 50%, 48% selected renting office space. Were they correct, Sam?
That is correct. It is renting office space. The other items are specifically excluded. They were all the leasing software would classify as an intangible asset. The power supply contract is specifically excluded, and service concession arrangement is also specifically excluded under GASB 87. Okay, so one of the important things you're going to have to calculate when you're looking at the lease is, and it requires some professional judgment. You're going to be required to calculate what the lease term is. So the lease term is the period during which the lessee has a non-cancelable right to use an underlying asset, plus the following periods. This is only if they're applicable, but it's covered by a lessee's or lessor's option to extend the lease if it is reasonably certain based on the relevant factors that the lessee will exercise that option. So again, you can tell by that definition that it's going to require some professional judgment. So is it, I think it needs to be a little bit above probable, like reasonably certain, it needs to be a pretty good threshold there that you need to meet to determine if it's reasonably certain. And then also to terminate the lease if it is reasonably certain based on the relevant factors that the lessee will not exercise that option. Okay, periods for which both the lessee and the lessor have an option to terminate the lease, or for which only the lessor has that option, are cancelable periods and are excluded from the lease term. This includes periods when both parties agree to extend the lease. So even if they both agree to extend it, it should not be included in the lease term. Provisions that allow for termination of the lease due to purchase of the underlying asset, payment of all the amounts due, default on payments are not considered termination options. A fiscal funding or cancellation clause is not a termination provision, and those should only be considered when they're reasonably certain that the clause will be exercised. Substance over form, we got to remember that a lot of times those have to be in the contracts due to legal reasons, but for the most part, governments really don't use it's not reasonably certain that they're going to exercise those options. So those can be ignored when you're calculating the lease term. At the beginning of the lease, the lessor and the lessee should assess all factors relevant to the likelihood that the lessee will exercise those options. So some factors are contract-based, underlying asset-based, market-based, government-specific, and some of the things to consider in your decision-making process are there economic incentives. So are there economic incentives for the government to stay in this lease? So then is it likely that they're going to use those extension terms? Economic disincentives to terminate. Is it going to, for example, relocation and negotiation costs? Does it behoove them to stay where they are? Is it going to cost more money for them to leave? So then it's more likely that they're going to not exercise those. The lessee's history of renewing, exercising renewal and termination options are a good indicator of whether or not they'll exercise those options. And then the extent to which the lease is essential to the government. So those are some factors to consider when you're trying to determine your lease term. And so got a question here from the implementation guide. A lease contract has a non-cancelable period of 5 years and specifies that at the end of the 5 years, both the lessor and the lessee have the right to cancel the lease or may continue the lease using the same lease terms on a month-to-month basis. Is the month-to-month basis, is the month-to-month holdover period included in the initial assessment of the lease term? And the answer is no. During the holdover period, the lessee has not contracted for a non-cancelable right to use an underlying asset. And the lessor is not required to continue providing the asset. So those would be excluded from the lease term. That is, the holdover period is cancelable by either party and should be excluded from the lease term. And you can find that information at paragraph 12 of GASB 87. So like I promised, that I said there would be some examples. So here, the first example we're going to go through, this is an example of the lease term. So the fact pattern is that a city enters a contract that gives it the right to use a transit bus for 5 years. After 5 years, there's an option to extend for 2 years. And then after 2 years, the city can terminate the lease. Also, not on the screen, but I'm going to read this to you. This is part of the fact pattern. The government regularly leases transit buses and has historically utilized the buses for the full term of the contract and has never terminated early. The contract does not provide the lessor an option to terminate. And at the date of the contract, the government does not have any intent to terminate early. At the end of the lease, the government intends to return the transit buses, and there is no transfer of ownership provision. So step one of our example, what is the cancelable period? Or excuse me, the non-cancelable period. That is the 2 years. Like we said in the fact pattern, after 5 years, there's an option to extend. But then after 2 years, the city can terminate the lease. So the non-cancelable period is 2 years. And so let's assess the options. Is it reasonably certain the termination option will be exercised? And no, it's not reasonably certain that the termination option will be exercised. Like I mentioned, they've historically used the full term of the contract. They've never terminated early. That would indicate to us that they would not terminate. And at the date of the contract, they have no intention to terminate early. So I would say no, that's enough evidence to say that they're not going to terminate, not going to exercise the termination option. So next question is it reasonably certain the option to extend will be exercised? And the answer to that, of course, is yes, because the fact pattern tells us that they've never terminated early. Using the history of the city, they're more than likely going to use the transit buses for the full term and then return them after. And then so looking at our example here, the non-cancelable period, that's years 1 and 2. They could cancel after 2 years. So the first 2 years was the non-cancelable period. And then the period covered by the option to terminate when it is not certain to be exercised was years 3 through 5. And then the period covered by the option to extend when it's reasonably certain to be exercised is years 6 and 7. So that would give us a total lease term of 7 years. So they're expected to use the full lease term, including the options to extend. So that'd be 7 years. Any questions on the lease term there? All righty. Well, every now and then you're going to run into you may have to reassess your lease term. So I wanted to mention that here. Lessees and lessors should reassess the lease term only if one or more of the following occur. The lessee or lessor elects to exercise an option even though it was previously determined that it was reasonably certain that the lessee or lessor would not exercise that option. So something's changed. The lessee or the lessor elects not to exercise an option, even though it was previously determined that it was reasonably certain that the lessee or lessor would, in fact, exercise that option. Or an event specified in the lease contract that requires an extension or termination takes place. Then you would reassess the lease term. So moving on to our actual reporting. So analyzing and journalizing, we've done a lot of analyzing, and so we're going to do a little more journalizing here. Taking a look at this chart here, you can see this gives us what the lessee and the lessor should book as assets or liabilities, or actually both. So if you look at what the lessee needs to book when they are leasing an asset, the right to use the underlying asset will be your intangible asset, and that will be the value of the lease liability plus any prepayments and initial direct costs that are ancillary to place that asset into use. And then the liability, that would be your debit for the lessee, and then your credit will be the present value of the future lease payments, including fixed payments, variable payments based on index rate, reasonably certain residual guarantees, and then you should use a discount rate, lessor's rate charge, if not present, the lessee's incremental borrowing rate. So if you don't have a rate, then you can use the lessee's incremental borrowing rate. But hopefully you're going to have that information when you book the lease asset. And then the lessor will recognize a lease receivable, and then they will recognize that will be their debit. And then on the credit side, it will be the deferred inflow, and that will be for the lease payments that will be coming in over the term of the lease. And then subsequent reporting, the lessee will amortize that right to use asset over the life of the lease. Actually, the shorter of the useful life or the life of the lease. And then you will, of course, reduce the liability by the lease payments. And then, of course, interest expense will hit the income statement. And then the lessor will reduce lease receivable by the lease payments. And then they will recognize revenue over the life of the lease term in a systematic, rational manner. Recognize those into revenue. And so here are the journal entries. So like we mentioned just a second ago, intangible right to use lease asset, you'll debit there, and then there'll be a credit to lease liability. And that'll be to recognize the lease asset and the lease liability. And then to recognize a lease payment, you'll debit the lease liability and, of course, interest expense, and then credit cash. And then in subsequent years, you will amortize those assets over the life of the asset. And so you will debit amortization expense and then credit accumulated amortization. And like I mentioned, it should be using a systematic, rational manner over the lesser of the life of the asset or the lease term, whichever is shorter. And so some of the journal entries using the current financial resources measurement focus, the lessee would report for funds using the current financial resources focus. That's at the fund level on a basis consistent with government fund accounting. So they would debit capital outlay, and then you would credit other financing sources, and that's to record the initial term of the lease. So this is very similar to the way we've been recording our leases. Oh, and then we've got our polling question.
All right, everybody, I think this is the final poll of the day. So let's finish strong here. A government that is leasing one of its capital assets to another entity should remove the leased asset from its capital asset schedule. Is that true or false? So you should have that question up in your little poll box. So I'll give you just a second to make a selection. Just in case you're having trouble reading or seeing the poll box, I'll read that question one more time. A government that is leasing one of its capital assets to another entity should remove the leased asset from its capital asset schedule. So true or false? If you don't see that poll, you can put it in the chat box. I don't see anybody in the chat box, so I think everybody must be having an okay time there. All right. A few more responses coming in. I'll give you just about 5 more seconds to make a selection here. True or false? All right. Pretty strong majority selected false.
And that is correct.
All right.
If a government is leasing their capital asset, they are leasing the right to use that asset. You're not actually leasing that asset. So you would leave that on your books and you would continue to depreciate it. So you're not transferring any ownership. You still own that asset. You're just leasing the right to use that to whoever you are leasing it to. So there would be no need to remove that asset from your books. And so we got a big example here for police. This pertains to a police car example. So on January 1st, 2022, the city enters a contract for 5 police cars. The contract states the term is 5 years with monthly payments of $3,000 due the first of each month. The interest rate is 6%. After 3 years, the city may cancel the lease. After the 5th year, the purchase price of each police car is $12,000. The city regularly leases its police cars and usually utilizes its police cars for the full term of the contract and is never terminated early. The contract has no options for the lessor to terminate. At the date of the contract, the city does not intend to terminate. At the end of the contract, the city intends to return the police cars, and then the contract has no transfer of ownership provision. So let's dive right into this example. So the first question is, do we have a lease here? We have the city's entered a contract for 5 police cars. That certainly sounds like a lease. Does it convey control of the police cars? I think the answer would be yes. They're going to pay for the police cars over 5 years with monthly payments of $3,000. So is this a right to use a non-financial asset? And the answer would be yes. So this would meet the definition of a lease. After 3 years, the city may cancel the lease, and then after the 5th year, the purchase price of the car is $12,000. And so what's the term of the lease? You can see that the term, the city has the right to cancel after year 3. And so in years 4 and 5, they would have the right. But as the fact stated, it said that it's not reasonably certain that they would exercise those. So we would consider the term of the lease to be 5 years. And should the purchase price be considered in the lease liability? And the answer is no. I threw that information in there to kind of throw you off a little bit. That really has nothing to do with the calculation of any of these items that we're going to talk about. That should be excluded from any of your calculations. The purchase price that they would pay to purchase them, that really has nothing to do with the lease liability. So what information do we need in the fact pattern to calculate the lease liability? So we need to know that the police cars were in fact delivered to the city, so that if the city has possession of the police cars. We know that it's a 5-year lease term based on the facts. We have a 6% interest rate. And then we've got the purchase price. Like we said, we need to exclude that. And then so the question becomes, what's the present value of $3,000 paid over 5 years, AKA 60 months? So what's the present value? There's the present value formula. If you want to, go ahead and you can start calculating using that formula. I'm kidding. That's a very bad joke. I know. I wouldn't expect you to use that formula. Hopefully, it doesn't bring back any nightmares of any finance classes that you had. So we're going to do it using Excel. So present value of $3,000 for 5 years or 60 months. you'd go into Excel and you would use the present value function, and you would put your 6% rate in, and you would divide that by 12. That would give you your monthly rate, and then you'd put the number of periods, so that'd be the number of payments, which would be 60, and then your payment would be $3,000. You want the future value to be 0 because we're taking our present value all the way down to 0 over the life of the 60 months. And then the type we are paying at the end of the period. This is not an annuity due, so you would put in 0, or you could leave it blank. So using all that information, if you were to plug that into your Excel function, then you would come up with a present value. So the present value of $3,000 payments over 5 years would be $155,177. And so you would calculate a payment schedule here on the $177. And so you would need to know your principal and interest. You'll need this for your disclosures. You would disclose the principal payments over the 5 years, principal and interest. Then you would need your total column, of course, and then you can see the amortization that's calculated off to the right, your amortization schedule over the 5-year period, $31,000 per year. So let's dive into the journal entries that we would use to calculate, that we would use to book these. So in a governmental fund, the initial journal entry, you're going to debit capital outlay for the $155,000, and you're going to credit other financing sources for lease proceeds, and that's to record the capital expenditure and the lease proceeds for the police cars. Then on your government-wide, this is to take it from current financial resources focus to the government-wide presentation. You would debit the lease proceeds that are in other financing sources for the $155,000, and then you would credit your lease liability for the $155,000. I've gone ahead and broken it out into the current and non-current portion. You're going to need those for your presentation on your financial statements. And then, of course, you're going to debit the intangible right to use leased asset for the $155,000, and then you're going to credit capital outlay for that same amount. So that will eliminate that on the government-wide presentation. And then your enterprise fund, this will be your initial booking in an enterprise fund. You would debit the intangible lease asset for the $155,000, and then you would credit lease liability. And again, I've broken that out for current and non-current. I know there's not a lot of enterprise funds that would use police cars, but let's just ignore that. Let's consider it like an excavator or something for a water or in sewer fund. And so that's how you would book that intangible right to use asset if you were leasing one of those assets.